Hi, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, here on Saturday, April 11th, 2020, to give you an update on just some of the data that we're seeing, some of our up-to-date observations. I see perhaps near term and then over the coming months. So to get right down into it, I think the data is becoming clearer and clearer as we get further into April that first quarter is likely we're going to witness a decline in economic activity, even though the first 2 months were strong. And the second quarter, obviously, we've got a massive dislocation of resources, which is frankly self-generated. And each cycle is unique, but we still draw from some history. Now, this one was not, this cycle change or this recession, if you will, was not born out of excesses or some type of a policy mistake, but it was basically engineered to shut down. And so this has really almost never happened where everything's been shut down. All the sectors have been shut down at the same time. Going into it, though, we had a $20 trillion economy, and the drawdown has been vast. Typically we've been fairly resilient in prior cases where we've had recessions, but usually there's been parts of the economy that have responded well and other parts that haven't. And in this case, basically most of the economy has just been shut down or curtailed significantly. But like I think coming out of 9/11, I think we'll see a kind of a little bit of a new normal of sorts. And I'll kind of explain perhaps what some of those look like. But right now, in terms of the second quarter, which is kind of that period from April that we're just starting in now, of everything, more so than it is about the lost activity that we've seen and kind of what we feel and the emotions and the neighborhoods and how the government and our elected officials are responding to this. So right now, the numbers matter less, but they still matter. But we'll get into this in a couple of minutes, but we're on the eve of a lot of first quarter earnings reports, and we're going to get a lot of feedback and kind of sentiment from company CEOs as we head into next week and through the ensuing weeks. I'd say we're gonna see a lot of curtailed forecasts. Even the Federal Reserve, in their latest set of comments, have kind of withdrawn their own forecast just because the data is so fluid right now. I do think that the second half, after this, very traumatic economic upheaval that we're going to see in the second quarter, it's actually probably going to be positive. At least that's what we're looking at right now. And that growth will persist into 2021. And we do think it's going to take about maybe 18 months to get back to where we were. And I've talked about some of the kind of the economic destruction that we're seeing now. It's not out of the question that, if we were to open by the end of this month, and this is, Brian Westbury at First Trust and some of the work that he's done, that we would, kind of sabotage about maybe 5% of the economy. And for each month thereafter, it's about another, 5 to 7% of the economy that is basically, or GDP, I should say, has basically been destroyed, if you will. And so, we'll just have to see when we begin to open again. But having said that, it just in the last few days, we're beginning to hear, I'll call them some green shoots, some pronouncements from officials, and even here in Texas, our own Governor Abbott is talking about ways to maybe get the economy back started again in a safe way. So we'll have to monitor those, and we'll probably have more updates in our next webcast here. So real quick, we know that the Federal Reserve has initiated basically unlimited quantitative easing, which means that they're increasing to an unlimited rate the amount of assets that they're buying, and they're now buying assets like corporate bonds and high yield and exchange traded funds. I mean, things that they've never bought before. So this is really kind of unprecedented. The measures have been robust. The Main Street funding vehicle that the Fed has is actually going to be purchasing loans that are made directly to as it would suggest, Main Street businesses, small and medium-sized businesses. So we know that the Fed is really backstopping that, and they're really providing a lot of support and liquidity that stands behind the banks. So as opposed to 2008, like we've mentioned before, we really don't have any concerns about the integrity of the financial sector right now. The government, we have the third round of stimulus. We're seeing that evolve right now with some of the CARES Act packages that have rolled out, and I think we're seeing the bureaucracy in action here. It's been difficult to process these applications. There's choke points. I think the big question is, how long is it going to take to get the funding and the assistance out into the channel? And we think it's probably going to take longer than certainly we thought about originally. Now the Senate has gone on recess, and they were not able to get through that fourth round of stimulus, and there was some I guess political infighting, if you will, but basically we've got $350 million that's going to small business, and that number is probably going to have to look more like $600 billion. Just from a debt standpoint, national debt standpoint, we've got $23 trillion in U.S. Treasury obligations outstanding right now. Best guess is that we add somewhere between 6 and 8 trillion to that debt load over the next couple of years. And right now there's not a whole lot of care for fiscal responsibility, if you will. But the question is, will that debt ever actually be repayable? And so we're pushing entitlement programs kind of to the limit down the road. And it won't be too long before 75% of our national budget is going to be encompassed with debt service on the national debt, entitlements, and healthcare. Let's see, we're obviously in a deflationary story right now. I think long term, the seeds have been sown with all this liquidity that we could have inflation down the road, but right now, that's not that's not the case. Unemployment, we've had 3 bad reports in a row now, as you've no doubt read. The last reading, which is a monthly reading, we went from 3.5% to 4.4% unemployment. But that number right now, considering the week that they took that reading, was just the second week of March, before a lot of the unemployment claims filings have been made. And we've had 10 million of those over the last couple of weeks. And that number for unemployment is probably closer to 10 to 15% right now. Manufacturing, we're in a global recession. We knew that we were having some trouble in manufacturing even before this, because we were just coming out of the trade spat between the U.S. and China, which had bogged down some supply chains. But there will be a period required to restart those supply chains once we kind of get more of the economy opening up. It'll take a while for capital spending to come back, and cash preservation may become paramount to spending. I think as a lot of companies, both public and private, are realizing that it's really a good idea to keep some cash reserve when you have something that's some exogenous shock that's going to cause you or cause the economy just to shut down. But it looks like from all of the data that May, we're going to begin to open up. Again, I mentioned there's some, like Governor Abbott here in Texas is talking about trying to do things in a smart way at a certain point in time. And you certainly hear that at the national level, even though the federal government is kind of pushing the onus on some of the states and other jurisdictions to make some of those calls. But May, I think we begin to open up. July, I think, is really kind of a time that we can say the economy will probably be back up and running. Again, barring any unforeseeables, and this is a little bit of conjecture, but based in large part on everything that I've been reading here lately. But what's clear to this point is that the worst case modeling is not proving to be true, and that's really a good thing. So we can be very optimistic about that. I've got some data, and then we'll get into talking about some of the market-related things and some of the valuation metrics, and then some observations on where we might be headed from here. We know that commercial and industrial loans, basically business loans, were up 83% on an annualized rate over the last 3 months. So we know companies are drawing, raising cash, they're increasing their liabilities. The money supply, the measure of money supply, which is called M2, which includes basically all deposits and like deposits at financial institutions, that was up 27.5% on an annualized rate over the last 3 months. And some of the more high frequency data that people like Brian Westbury at First Trust look at, and this is coming from his latest call. These are high frequency, meaning daily or weekly type data that we get every day or every week. Initial claims, as we know, bad number, that went from basically 200,000-ish in a week to over 6 million. Weekly retail sales actually remain positive, likely due to grocery stores and other type of shopping as people were stocking up for the long haul here. It goes without saying, box office receipts were basically down 100%. Rail shipments were down 11.8% year over year. Steel production was down almost 20%. Hotel occupancy was down 67%. Basically, Open Table had announced basically 100% drop in reservations. Not surprising when restaurants were closed. And the last couple of readings that Brian highlighted in his last call were TSA measures throughputs in airports. And for this past week, a year ago, there were 2.38 million travelers. In the same, basically last week, there were 108,000, which is like a 95% drop. And then gasoline sales were down 27% last week. So just in terms of the stock market and what we've seen, we've seen a fairly decent and positive response to in the markets. I think we've kind of, I would agree with Brian Westbury and some of the others that feel like we probably hit our bottom, even though we may go back and try to retest it at some point. We've had more optimism. We've kind of flushed out the sellers that were panic selling, on the eve of all of this bad news, and we're starting to see some of the buyers get back in. The stock market typically turns before the economy does. And a couple of other perspective points from First Trust. If you look at the S&P 500 in 2019, it was up almost 29%. And year to date in 2020, it's down 16.7. So the market actually from the beginning of 2019 is actually still up 12%. If you can imagine that through all of the tumult that we've seen and the volatility. And similar story for the NASDAQ, which is actually up over 20% point to point from the end of 2018 to now. But in terms of valuations, it's kind of hard to know where we are, because in that the valuation is determined as price over earnings. And we don't really know what the E in the earnings is going to look like right now. So we can't really tell if stocks are really cheap. And stocks are clearly, though, pricing in a sharp recession. I see a lot of companies, even in the early pre-announcements that we're seeing now, they're beginning to withdraw their earnings guidance. And we'll probably see some companies begin to curb their dividends and lower their dividends. A lot of the larger companies, the publicly traded companies that you would recognize, have several months, and they have stores of liquidity. They have lines of credit to draw upon. So from a financial wherewithal point of view, there are a lot of companies in the public domain that actually are in pretty good shape balance sheet wise. But again, like I said earlier, when you hear these calls, companies that are reporting their earnings, the numbers are going to matter less than what their outlook does and what their current pulse check looks like. Consensus estimates have been going down consistently, and from a year ago, they're down about 16%. And if you look at today's prices, they're about 18 times for those that are, kind of monitoring what valuations look like. I mean, 18 times earnings for the S&P 500 is not a value. It's not terribly expensive, but it's what you believe the earnings are going to be that matters. And we've seen some some estimates for earnings that are much, much lower than what we're seeing, than what the consensus number is. And that would put valuations over 20 times, and that would certainly not make stocks necessarily cheap at this point. Valuation, I think, matters less than sentiment, like I said. And so if there's a positive sentiment that there will be a resolution, we're getting better data on the virus itself. As we get closer to opening up the economy, I think we're going to have more optimism, and there's going to be more of a risk-on attitude and more of an appetite for stocks, regardless of what that empirical value might be. But corporate profits, I think, by all estimates that I've read, are going to be down about 25%, based on what everyone sees right now versus a year ago. Although the market seems to be pricing in something that's, at least 2.5 times that. And like I said before, it probably takes about 18 months to kind of recover what's been lost in the economy, and that's going to be driven a lot by the ability for companies to generate profits. And earnings are going to just take time to recover. And two anecdotes. I know I mentioned the banking sector feeling like they're real strong. Housing will not be immune to what's going on now, but feel like even though mortgage applications were down 18% last week, that there's still kind of a bedrock of housing, and I think housing is in better shape than I think some people estimate. And then next, in terms of valuation, this is just something that I found extremely interesting that I've watched. Again, coming from First Trust, they look at capitalized profits. And so, the way that they do that is they look at the 10-year yield, which is now, it's now about 80 basis points, or 0.8%, but they used a 1.7% 10-year U.S. Treasury yield, which is where it was in mid-February before we began to have this market trouble. But basically, that assumes that corporate profits would have to fall 50% from here for the market to be at fair value. But the corporate profits are pricing in basically something that is significantly lower than I think where the conventional wisdom feels that we're going to be. So again, valuation, I think, is still, is still very sentiment is still very pessimistic, even though we've had kind of an updraft from the bottom. Just a couple of takeaways before we conclude here today. I think some of the, we really have we've set a precedent here in COVID-19 on, the shape and texture and really the involvement of government. We're going to see a strong growth of government here. In fact, a permanent change, a permanent increase. And so how do we, and how are we going to react to every virus outbreak? Is it going to be this, both barrels loaded and ready to go? Obviously, we're going to have to. We're going to have to really step up pandemic preparedness, which did happen actually after the H1N1 virus in the Bush administration. But we're going to have to really bolster that, and then I think what's going to happen, and you're going to see some renewed interest in I guess, addressing some national security issues when you have 80% of the prime ingredients that go into pharmaceuticals that are manufactured in China. I think what we're going to see is more onshoring, kind of a reversal from globalization, which had been the trend over the last decade. That's going to have an impact on companies that will have inherently higher manufacturing costs, because if they're onshore and the cost of labor in the U.S. is higher than it is overseas. So we'll have to see how that impacts profits, but I definitely see a trend where more companies are going to onshore, especially in pharmaceuticals and other areas that have a national security sensitivity. I've mentioned this before, more telecommuting, telemedicine, more shift in the retail model from in-store purchases to online. And I think just from a company standpoint, what you're going to see is not only from the large company standpoint, but also from small and medium-sized businesses on wanting to maintain more liquidity, maintain more cash. The average small business has basically about 25 days to 30 days worth of cash on hand, which basically, when you shut them down, they have a month to survive before they literally have to shut their doors. And I think you're going to see a reaction to that coming out of this, that more companies are going to hold cash. And the question is, especially on small businesses, what is that going to do to consumption? I think that's something we're going to have to watch. I think you could see those savings rates go up, and we've had fairly low savings because that's translated into more consumption, and consumption is 70% of our economy, and so basically the engine of the world economy is the U.S. consumer. And if that U.S. consumer is going to save more and spend less, then what you'd see is perhaps a slower net growth rate globally, because the consumption and demand for not only U.S. made goods but goods made overseas, might ebb a little bit. And again, I think that the fiscal conservatism is going to probably ramp up on the part of companies, just wanting to make sure, hey, if this ever happens again, I want to make sure that I've got more seed corn set aside. But there's a lot of data in there. There's a lot of things that we still don't know that are evolving. The key takeaways are, at least from a virus standpoint, as tragic and horrific is to hear the increase in the death toll. It does seem like flattening the curve is working, and we're getting less transmission, and that the data on new cases seems to be trending in the right direction. We're getting a more optimistic tone from some of the people that are in touch very closely with the data, so that's positive. And we know that there's already fiscal stimulus that needs to be channeled into the pipeline. And in addition to that, we're seeing a lot of municipalities that are taking funds in reserve and beginning to try to channel those at the local level into the small businesses. So that's all very positive. But we are on the cusp of a fairly bleak and unprecedented drop in the economy, kind of on the order of magnitude that we haven't seen since the Great Depression. But I feel like it's fairly short-lived once we turn that rocker switch. Again, this is engineered. This is not a function of excess or function of fiscal, problems or fiscal errors. So again, we look at kind of the beginning of May and that transition into June, where we get a little bit more economic activity, and then hopefully July that we're steady state, and then that'll set the stage for positive growth in earnings and the economy in the second half of the year and on into 2021. But as we see more data, we will continue to provide you updates. In the meantime, please don't hesitate to reach out to us. www.bkawealth.com, or feel free to reach us at our emails, cell phones, company phone, however you can to reach out to us. We're here for you, and we hope you have a wonderful Easter weekend.